We all want to make money in the stock market. It's the American dream to buy low and sell high, right? But what if I told you that beating the market is incredibly difficult, even for the professionals? You heard that right. Those Wall Street hotshots with their fancy suits and Bloomberg terminals often struggle to consistently outperform the market averages. Why is that? You might think they have access to better information or some secret sauce. The truth is far more humbling. The market is a beast with a mind of its own. Trying to predict its every move is like trying to catch lightning in a bottle. So what's an individual investor to do? Should you just give up and buy lottery tickets instead? Absolutely not. There's a way to play the market game and come out ahead, but it requires a shift in mindset. You need to stop trying to beat the market and instead aim to match it. That's where Burton Malkiel's A Random Walk Down Wall Street comes in. This book, a Wall Street classic, challenges conventional wisdom and offers a refreshing perspective on investing. It's a must-read for anyone who wants to take control of their financial future. Malkiel doesn't hold back in his critique of traditional investment strategies. He uses a powerful analogy to illustrate his point: a blindfolded monkey throwing darts at a wall plastered with stock listings. The monkey's portfolio, Malkiel argues, would perform just as well as one carefully crafted by Wall Street analysts. Now, this isn't to say that all stock picking is pointless, but it does highlight a fundamental truth: the market is incredibly efficient at pricing stocks. All available information from earnings reports to industry trends is already reflected in a company's stock price. This concept is known as the efficient market hypothesis, and it's one of the cornerstones of modern finance. It suggests that trying to outsmart the market by uncovering hidden gems or predicting short-term fluctuations is a fool's errand. So, if the pros are essentially playing darts, does that mean you're doomed to fail as an individual investor? Not at all. In fact, Malkiel's book offers a ray of hope. You can achieve your financial goals by embracing simplicity and taking a long-term perspective. Let's talk about fundamental analysis. Sounds complicated, right? It's basically the process of examining a company's financial health, its management team, its industry position, and a whole bunch of other factors to determine if its stock is a good investment. Think of it like kicking the tires on a used car. You want to make sure the engine is sound, the transmission is smooth, and the car's history is clean before you hand over your hard-earned cash. Fundamental analysts pore over financial statements, read industry reports, and even talk to company management to get a sense of a company's true worth. They're looking for undervalued stocks, those diamonds in the rough that the market has overlooked. The problem is, everyone else is doing the same thing. With so many smart people digging for information, any edge you might gain from fundamental analysis is quickly arbitraged away. Remember, the market is efficient. Now, fundamental analysis isn't entirely useless. It can help you understand a company's business model and its long-term prospects, but it's important to be realistic about its limitations. One of the biggest flaws in fundamental analysis is its reliance on the firm foundation theory. This theory suggests that every stock has an intrinsic value, a true worth that's determined by its future earnings potential. The problem is, this intrinsic value is subjective and constantly changing. What one analyst sees as a bargain, another might view as a value trap. And even if you're right about a company's long-term prospects, the market might take years to recognize its true value. In the meantime, your portfolio could be lagging behind the overall market. Remember, time is money. While you're waiting for a stock to reach its intrinsic value, you could be missing out on potential gains elsewhere. Section 5. Charting the unknown, the limitations of technical analysis. Now let's talk about technical analysis, the other side of the investment coin. If fundamental analysts are like detectives, poring over clues to uncover a company's true worth, then technical analysts are more like astrologers, looking for patterns in the stars. They study charts of past stock prices, searching for trends, patterns, and indicators that can predict future price movements. They believe that history repeats itself, and that by studying the past, they can gain an edge in the market. Sounds tempting, right? But here's the catch. Technical analysis suffers from many of the same flaws as fundamental analysis. It's based on the assumption that the market is predictable, that there are discernible patterns that can be exploited for profit. The reality is far more chaotic. The market is influenced by a myriad of factors, from economic data to geopolitical events, many of which are impossible to predict. Trying to forecast future price movements based on past performance is like trying to predict the weather by looking at old almanacs. Section 6. Fear and Greed, the emotional roller coaster of investing. Now let's talk about the human element in investing, because let's face it, we're not robots. We're emotional beings, and those emotions can wreak havoc on our investment decisions. Think about it. When the market is soaring and everyone is making money, it's hard not to get caught up in the euphoria. We become overconfident, believing that the good times will never end. We start taking on more risk, buying high and chasing momentum stocks. Then, inevitably, the market takes a turn. Doubt creeps in, fear takes hold. We sell our winners too early and hold on to our losers for too long, hoping for a rebound that may never come. This cycle of fear and greed is a tale as old as time. It's what drives market bubbles and crashes, and it's one of the biggest reasons why individual investors often underperform the market. Section 7. The random walk prices take an unpredictable path. So if fundamental analysis, technical analysis, and our own emotions can lead us astray, is there any hope for us individual investors? Absolutely. But it requires a shift in perspective. We need to embrace the idea that stock prices often follow a random walk. This theory, popularized by Malkiel, suggests that short-term price movements are essentially unpredictable. Think of it like flipping a coin. Just because it lands on heads 5 times in a row doesn't mean it's more likely to land on tails the next time. Each flip is an independent event. The same is true for stock prices. Past performance is not indicative of future returns. Trying to predict short-term price movements is like trying to predict the next flip of a coin. Section 8. Efficient markets, why it's hard to outsmart everyone else. Now let's revisit the efficient market hypothesis. This theory, which we touched on earlier, suggests that stock prices already reflect all available information. That means it's incredibly difficult to consistently find undervalued stocks or predict market movements. Think of the market as a giant information processing machine. Millions of investors around the world are constantly buying and selling stocks, reacting to news, analyzing data, and placing bets on the future. This collective wisdom of the crowd is reflected in stock prices. That's why it's so hard to beat the market consistently. You're not just competing against Wall Street analysts, you're competing against millions of other investors, many of whom are just as smart and resourceful as you are. So, if the market is efficient, does that mean it's impossible to outperform? Not necessarily, but it does mean that you need to be realistic about your chances. Section 9. Index funds. The simple path to market returns. So, if trying to beat the market is a fool's errand, what's an individual investor to do? Malkiel's answer is simple. Index funds. An index fund is like a basket of stocks that tracks a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. When you invest in an index fund, you're essentially buying a tiny piece of all the companies in that index. Index funds offer several key advantages. First, they're incredibly diversified. Instead of putting all your eggs in one basket, you're spreading your risk across hundreds or even thousands of stocks. Second, they're low cost. Index funds typically have very low expense ratios, which are the annual fees charged by mutual fund companies. This means more of your money is working for you, compounding over time. Finally, index funds are simple to understand and manage. You don't need to be a financial expert to invest in an index fund. Just set up a regular investment plan and let the market do its work. Section 10. The long game time is your greatest ally. Now here's the most important lesson from a random walk down Wall Street. Time is your greatest ally in investing. The longer you stay invested, the more time your money has to grow. Think of it like planting a tree. It takes time for a tree to grow from a small sapling into a mighty oak. You can't rush the process. You need to be patient and let nature take its course. The same is true for investing. Don't get discouraged by short-term market fluctuations. Stay focused on your long-term goals. Ride out the storms. The market has always gone up over time, and there's no reason to believe it won't continue to do so. Section 11. Keep it simple. Strategies for successful investing. So, there you have it. Malkiel's A Random Walk Down Wall Street offers a refreshingly honest and practical approach to investing. It teaches us that trying to beat the market is a fool's errand, and that the best way to build wealth is to embrace simplicity and take a long-term perspective. Here are some key takeaways from the book. Don't try to time the market. it's impossible to consistently predict short-term market movements. Invest for the long term. Time is your greatest ally in investing. Diversify your portfolio. Don't put all your eggs in one basket. Keep your costs low. Expense ratios can eat into your returns. Control your emotions. Don't let fear and greed drive your investment decisions. Remember, investing doesn't have to be complicated. By following these simple strategies, you can achieve your financial goals and secure